Hey everybody, Smart Silver Stacker here. Hope you're doing well. Hope you had a great weekend. We just got a fairly ominous warning from the International Energy Agency, warning that inflation may be on the rise once again in a very big way. Now, I know that we just got a bit of a reprieve in the latest CPI numbers, the monthly data for March, revealing that the year-over-year inflation rate, according to the CPI, the official numbers, is down to 5%. Now, of course, that's nowhere near the Fed's 2% target, but still a bit of a reprieve from what we have been seeing. But it looks like that trend could very well be very short-lived. And I'm expecting, after seeing this data from the IEA, that inflation and prices across the board are going to be higher towards 2024 as we approach 2024. And that goes for the metals as well. I believe that even though the metals are currently elevated, I think they're going to be going higher by year end, both gold and silver. And did you know that SD Bullion is giving away a monster box of 2023 Silver Eagles? You can sign up today at sdbullion.com/sweepstakes. And if you haven't checked out silverbotanicals.com yet, what are you waiting for? You can check them out with a link down in the description. They've got an amazing line of household and personal hygiene products powered by nano silver. Don't forget to use coupon code STACKER at checkout to save 10% on your Silver Botanicals order. Okay, so this warning from the IEA, the International Energy Agency, they have warned that rising energy prices could hurt the global economic recovery and that they could lead to much higher inflation. So according to the IEA, even before the recent cuts in petroleum production by OPEC Plus, that's Saudi Arabia and OPEC and also Russia, to the tune of about 1.5 million barrels per day, even before those cuts, the energy markets globally were set to tighten by the end of 2023, and that was already set to lead to the potential for, their words, a substantial supply deficit. So they didn't go so far as to label it a shortage, but that is essentially what a supply deficit is. And according to the IEA, again, with the recent cuts, this has become a near certainty. And they have warned that consumers who are already affected by inflation will be hit with further rising prices as we move towards the end of 2023. And you can see these charts, which represent global oil supply and demand, and the dotted lines there, those are forward projections. So this gives us some data up until this point, and then also some projections for 2023 as 2023 plays out. And you can see that right now demand, while it is below supply, it is set to surpass supply by quite a bit by year end. And we know what happens when demand exceeds supply. We get much higher prices. And you can already see this beginning to play out in this chart from the EIA. That's the Energy Information Administration. That's a domestic U.S. agency here. This is a chart of gas prices in the U.S., kind of a composite or average price of gas. And you can see that it has come down quite a bit from the highs that we saw in 2022, with the average price of gas being over $5 a gallon. But in recent weeks, this is a weekly chart, it is beginning to tick back up again. And in order to get that decline from the highs of 2022, you got to keep in mind that the U.S. released almost half of the oil in the strategic petroleum reserve. And now at the levels that it's currently at, you got to go back to the 1980s to find levels this low. And now we are entering into a period where OPEC is cutting oil production more. Russia is cutting oil production more. They did that in response to the oil cap scheme. And OPEC just recently announced this kind of surprise cut of their production by about 1 million barrels per day. So we're experiencing that at the same time that the U.S. is no longer releasing this oil from the Strategic Petroleum Reserve. And who knows, maybe they will release more oil, but I mean, it seems pretty unwise to do that at this time, considering the fact that we are geopolitically on the verge of a major multi-theater conflict. You'd think that heading into that, you'd want to at least have some of your petroleum reserves intact, but who knows? But even if they do decide to release more oil from the SPR, I mean, that's only a trick you can play so many times, because eventually it runs out. And then to the extent that you want to refill it, you've got to go into the market and buy oil. So it's not a magic bullet by any means. And the real point here is that Production is coming down, and yet demand is rising. And I talked about this months ago when Russia first announced that 500,000 barrel per day cut. That was in response to the G7's oil price cap scheme designed to limit Russian profits. And their response to that is say, well, if we're not going to make the profits, we're just not going to produce as much oil. And also, China has been reopening following their pandemic lockdowns. And now that we have this OPEC production cut, this Saudi production cut, even more oil production has been cut, and we've got this new warning from the IEA. It kind of confirms that earlier forecast, and it shows that the effect of these oil production cuts are going to be even more drastic than initially appeared. Now, I know, I mentioned it earlier, we got the 5% CPI reading year over year in the latest monthly data. We know that the CPI understates real inflation. That is a given. They use all sorts of tricks, hedonics, adjustments to misrepresent what consumers are actually experiencing as they shop. And anybody who has been shopping or purchased gas or bought anything really, that inflation is higher than 5%. But even if we take that 5% number on its face, it's still nowhere near the Fed target of 2%. And this drawdown in inflation, this disinflation, has been dragging its feet all along. And inflation has already proven to be a much more persistent problem than previously expected. But in the next month's inflation numbers, that's when the production cuts are really going to start to show. And I think the full production cuts don't even go into effect until sometime in the future. And so it's going to be the numbers for May, for June, for July, where we really start to see the effects of these oil production cuts in the inflation data. And the Fed is doing their part. They're helping along this inflation thing with their money printing, and we're going to get a lot more money printing. I mean, don't worry about that. It's coming. We've got a war in Ukraine that appears to be on the brink of expanding to a wider conflict. And according to the recent leaks, the intelligence leaks, we've already got U.S. Special Forces operating there. And if that war expands, we're going to print to finance it, of course, because we're already $31.6 trillion in debt. We don't have any cash to finance it with. So how do they finance everything? Via printing and inflation. If we get China invading Taiwan, they've really been ramping the rhetoric over there, and we are forced to intervene if we try some kind of military intervention. That will likely be very costly. How are they going to fund that? Well, they're going to print the money to pay for that, of course. If we get more bank collapses, then the Fed is going to print to make them solvent. We know that. They've already tipped their hand with their BTFP program and the recent expansion of their balance sheet. We know that if there's any more weakness in the domestic economy, the Fed is going to paper it over. So you've got multiple factors here, the potential for a lot more printing, plus there's a lot less tangible stuff, that's barrels of oil being produced. So it is a recipe for much higher inflation. And as far as the spending goes, I covered the recent report from the Treasury, which showed something like a $1.1 trillion deficit in the first 6 months of this current fiscal year. That's October through March. But if you ask me, they're just getting started, and I wouldn't be surprised if we see a higher than $2 trillion deficit for this fiscal year as we finish it up. We're in the second 6 months right now, and there's much more printing coming. There's really no sign that that is going to stop anytime soon. And when I say printing, printing and spending kind of interchangeable, because we know that at the end of the day, this debt is not really payable, and it all would be taken care of through debt monetization, through QE, through these various schemes of the Federal Reserve and central banks around the world. And I don't think it's going to stop anytime soon, folks. I've mentioned before this fourth turning that we're going into. If you haven't read that book, that is worth a read. It's kind of eerily accurate in some of its forecasts. They forecast that in the year 2020, there would be a major event which would shake up the world. We certainly saw that. And then that as we head into the year 2026, we will be more and more entering into a time of uncertainty and a time when the global strata, the global economy, the global geopolitical order is going to be shaken up and completely changed. And that forecast, certainly as the years have played out, it seems to be an accurate one. So I would think that at least for the next several years, we are going to see more and more disruption to the global economy, to the dollar-based system, and higher inflation is probably just going to be the beginning of all of that. And between now and then, between now and the end of the year 2026, I expect that huge amounts of fiat currency will be printed. And I can't tell you exactly why it's going to be printed, but something's going to come up. There's going to be more of this problem, reaction, solution stuff, whether it's war, cyber attacks, disease, whatever. The solution to these problems always seems to be to print more currency. Somehow that fixes everything, but expect more of that. And we know that investors are already becoming aware of this situation. Premiums on physical metal remain elevated, and that is a sign of a disconnect between the physical and the paper markets. And investors, they understand that physical metal is the real safe haven against all of these shenanigans by central banks. And that's why premiums are on the rise. It's not greedy dealers, it's supply and demand. Paper is just no substitute for the real thing. I know on Friday we did see a bit of a correction in the price of both gold and silver, but at the time I'm recording this video, gold still up over $2,000, silver still up over $25. So to me, it looks like this is very likely just a normal correction. In the interview I just did over the weekend with John Lee, he pointed out that these downturns in the precious metals are often on a Friday, and his theory there is that this is the result of some kind of blatant manipulation. It's kind of funny. We were recording that interview on Friday morning, and then as soon as I finished it up, I looked at the metals market, and it's a Friday, and I see the price of metals getting smacked down. So eerily prescient. If you didn't check that interview out, you definitely should check it out. It was a good one. But I would be curious to get your take on this correction that we have seen in the price of precious metals just this past Friday. Do you think it's just a normal downturn in a bull market? Is the price of the metals going to just start moving right back up? Do you think it was the result of some kind of cartel manipulation? And I think the idea there is that if they do this on a Friday, it's because you're entering into an illiquid period, the weekend, people can't place trades. Leave me a comment down below to let me know what you think. Or do you think that we're just in a new bear market for precious metals and they're just going to go lower from here? Just whatever you think, leave me a comment down below. In my opinion, it's a nice opportunity to get your hands on some more physical metal. I like to stack on days when the metals are in the red. I don't like to buy when they're on a rip higher. I like to wait for that little pullback and then get in there. Who knows, if we see more of a pullback this week, maybe I'll pick up some more physical metal. I did just get this gold sovereign from ST Bullion, or I'm sorry, not a sovereign, it's a gold Britannia, 1 ounce. And it finally made it my way. It took about 2 weeks from the time I placed the order, a little bit more actually, but they are still shipping out metal over there, even though they are a little backed up. Like a lot of the online dealers, the big dealers, seem to be backed up with orders these days, along with rising premiums and diminishing inventories. But we're not at a gold or a silver squeeze yet. If you have to wait 2 weeks to get your precious metals, that is not necessarily indicative of a squeeze. But when the next black swan event occurs, when we see the next major upleg in this bull market, and I do think that is coming very soon, probably going to have to do a lot more than wait 2 weeks to get your hands on physical metal. It may very well be the case that the stuff just becomes unobtainable if we see a major black swan event. And the way that the situation is playing out, the world is kind of ripe for these events at this moment, whether it be the global push for de-dollarization, the anti-U.S. hegemon, the BRICS nations proposing this currency or this new scheme to price oil in Chinese yuan or gold stablecoins, or whether it be the very real possibility of a kinetic conflict breaking out, whatever it is, or just more bank failures. Fortune tells us that U.S. banks are sitting on $1.7 trillion in unrealized losses. If we start to see more bank runs, the Fed might have to step in and print even more money, even more rapidly. But when any of these events occur, and again, I don't know what it's going to be. Maybe it'll be commercial real estate. We've heard a lot of murmurs about trouble brewing there. But whatever it is, the system is so fragile and it's so levered up at this point that we are in real risk of a currency crisis, of a confidence crisis in the global financial system, in the dollar-based system. And when that becomes more apparent to more investors, there's going to be a huge influx of interest into physical precious metals. So you want to make sure you get a seat at the table before that happens. It's not financial advice. I'm just telling you what I'm doing, but I am continuing to just slowly accumulate more hard assets because I think the writing is on the wall for the global economy, and we are entering into a period of a fourth turning. And again, I don't have a crystal ball. I'm not smart enough to know what is coming, but it is clear that the situation is deteriorating. and that the global economy is very fragile right now. That's really the key to it. There's too much debt. There is too much inflation. We have rising rates. And, the Fed, they've been at this game for a long time now, 52 years that the dollar has been on a purely fiat standard, and that takes its toll on a currency. And dollar's getting a little long in the tooth, folks. I don't know when it's going to come crashing down. I don't know when the Schumer's going to hit the fan, when the oscillating device will be struck by the crapola, but I believe it is coming. So leave me a comment down below to let me know what you think about all of this, and thank you all very much for watching. I will catch you next time. Smart Silver Stacker, out.